Good afternoon, and thank you for joining the National Conference of State Legislatures and the Pew Charitable Trusts for this webinar entitled Risk and Return, Public Pension Funds Complex Investment Strategies. My name is Anna Petrini, and I'm a policy specialist in the Labor, Employment, and Retirement Program at the National Conference of State Legislatures. I'll be serving as the moderator of today's webinar. As a reminder, if we could please go to the next screen. For best results with the audio portion of this event, we encourage you to use the unique telephone dial-in information contained in the registration email you received. The National Conference of State Legislatures is pleased to partner with the Pew Charitable Trust to bring this webinar to you. In case you're not familiar with NCSL, we are a bipartisan organization that serves the legislators and legislative staffs of the nation's 50 states, its commonwealths, and territories. NCSL provides research, testimony, and opportunities for lawmakers to exchange ideas on pressing state policy issues. State retirement issues fall primarily within the jurisdiction of one NCSL standing committee, the Committee on Budgets and Revenue. NCSL's standing committees allow legislators and legislative staff to exchange state experiences in shaping public policy and managing the legislative institution. They meet twice a year at the NCSL Legislative Summit and the NCSL Capitol Forum. For more information on these meetings or NCSL's activities and services to legislators and legislative staff, please visit our website at www.ncsl.org. Next slide, please. I'm sorry, go back. Thanks. This jointly sponsored webinar will explore how, with the goal of achieving higher returns, public pension funds have shifted away from low-risk investments such as bonds in recent decades. Instead, they've grown increasingly reliant on alternative investments like private equity, hedge funds, and real estate. But with the higher returns comes higher risk. We'll hear from experts with the Pew Charitable Trusts, a ratings agency, and the state of Pennsylvania as they discuss recent trends and the implications of these complex investment strategies for state budgets. After we hear from our presenters, we will open up the discussion to include questions from the audience. To ask questions, you can simply type a question in the Q&A box in the right-hand corner of your screen. Your question will not be visible to everyone, only to the webinar administrators. We will take as many questions as possible within the time we have available. Next slide. Our first speaker today will be Susan Banta, Director of Research for State's Public Sector Retirement Systems with the Pew Charitable Trust. She is a fiscal economist with over 20 years of experience in advising governments on public finance, tax policy, budget formulation and execution, tax administration, and revenue estimation. At Pew, Susan leads a team of researchers studying state retirement system funding policies, investment practices, governance, and benefits. She most recently served as Senior Budget Officer in the Executive Office of District of Columbia Mayor Vincent Gray, where she advised the mayor on tax policy and managed the economic development portfolio of the district's $10 billion annual budget. She was also director of the Office of Policy Analysis at the Council of the District of Columbia and a director with KPMG Barron's Group, where she advised state and international governments on fiscal reform. Next slide. Our next speaker is Todd Hauser, Director of S&P Global Ratings for Municipal Pensions. He is currently helping to develop a detailed framework to evaluate the sustainability and security of public pension and OPEB plans across the country. This involves establishing best practices for retirement benefits evaluation through risk identification and assessment, construction of mitigation techniques for distressed plans, enhanced criteria analysis and development for the ratings process, and augmented communication and outreach to all related stakeholders. Internally, he works with analysts to deepen their understanding of retirement benefits and consults on related high-impact credits. Prior to joining S&P, he was a senior pension actuary for CalPERS, the California Public Employees Retirement System, where he led a team on modeling and evaluating ALM and other system risks. Next slide. As our final speaker, we welcome Representative Mike Tobash, who is serving his fourth term in the Pennsylvania House of Representatives. During the 2017-18 legislative session, Representative Tobash is serving on the House Agriculture and Rural Affairs, Education, Insurance, and Liquor Control Committees. Additionally, he is serving as a Deputy Policy Chair for the House Majority Policy Committee and chair of the Public Pension Management and Asset Investment Review Commission. His extensive work on reforming Pennsylvania's underfunded public pension systems includes introducing House Bill 1499 in 2016, a side-by-side hybrid pension plan designed to reform the PSERS and SERS systems, with savings estimated from $11 to $15 billion. Additionally, he has enacted legislation supporting the insurance, anthracite coal, and automotive industries, and has worked to cut back on standardized testing in schools and to build business education partnerships. Born and raised in Schuylkill County, he understands the concerns and challenges of working in a family-owned business as the owner of Tobash Insurance Agencies. We look forward to hearing from each of our distinguished speakers. Next slide, please. And next slide. Now I will turn the program over to Susan Banta at the Pew Charitable Trusts. Welcome, Susan.
Thanks, Anna, and thanks for that lovely introduction. Thanks also to NCSL for organizing this webinar. We're excited to be here and excited to speak to all of the participants. I thought I would start my presentation with a little historical context, particularly our recent research shows an increasing vulnerability of state plans to economic downturns, and I want to set the stage and show a little bit of that research. This first slide illustrates state and local pension debt as a percent of GDP over the last 50 years. And I want to draw your attention in particular to the two downward spikes, the first one in the year 2000 and the second again in 2008. What we see here is pension debt as a share of GDP spiking after each of the downturns. But what's interesting is the fact that there's no recovery following these spikes. What we see is kind of a steady as she goes following the upward spike in 2000 and again in the upward spike in 2008. And this is important because what we're finding is the recovery is not generating a decrease in pension debt, and we now find ourselves at a historic high level of pension debt as a percentage of GDP. Next slide. At the same time, in response to declining fiscal positions during that period, states have literally doubled their contributions to state-sponsored plans over the last 15 years in relation to state revenues. So we're seeing increases in contribution, but no decrease in pension debt. And those two things happening in concert are important to keep in mind. In addition, funds are also, over this period, being exposed to historically high levels of risk. This graph illustrates a couple of trends over the last 30 years. The top blue line is the average expected return of state pension plans in the United States. And you can see it's pretty flat. It ranges from a little over 8% at the beginning of the period all the way down till 2018. The average is about 7.5%. So expected returns are not changing over this period of time. But if you look at the gold jaggedy line, that shows the risk-free rate of return over the same period. And in this case, it's the Treasury 30-year bond yield. And so you see this increasing difference between expected returns and a risk-free return. And the blue jaggedy line just shows you the difference. And that's the risk premium that funds are seeking, and it's ever increasing over this period. And I just want to point out that that's a fourfold increase over the years portrayed here, which is pretty substantial. And finally, again, despite increases in contributions, there's been a continued increasing gap between benefits, which is the blue line. Again, this is across the entire U.S. system, and contribution, which is in the gold line. And over time, that gap is increasing, which means that assets, the percent of benefits, is continuing to decrease over that period, although there's some fluctuation with the market. So again, setting the stage here, despite the longest economic recovery in recent history and a doubling of state contributions over the period, plans have really never faced the situation they're facing now, and we feel like they're as vulnerable as they've ever been to the next economic downturn. And this is really an important point to make at the outset of this webinar because it highlights the importance and the timeliness of the participants and the experts presenting here, kind of exploring the risk exposure of plans moving into the future. Now, before we leave the topic of context, there is some good news, and I don't want to be all doom and gloom. Across the 50 states, we've seen a tremendous amount of reform, particularly for new workers entering public pension plans. And the savings from those reforms will slowly be realized in the coming years. At the same time, the retired population that are members of these plans will begin to decrease over the next couple of decades. And of course, this will lead to reductions in benefit payments over that period. And then finally, there are states, Wisconsin and Tennessee are two examples, that actually have well-designed risk mitigation strategies that kind of insulate them from some of the largest variations in the market. Next slide, please. And this really highlights the idea that risk management is really essential, particularly in this environment. For example, the positive cost trends that I was talking about take time to make a meaningful impact as more and more workers are under reformed plan design. And states that are already in a very weakened position have a decreased capacity to weather economic downturns. So I'm going to read, this is the only slide where I'm actually going to read the text because I think it's so important. As a result, careful attention to the cost and design of investment policies and a forward-looking stress test analysis are essential. What gets managed, or excuse me, what gets measured gets managed. And by the end of my presentation, I'll talk a little bit about our recommendations in that regard. Next slide. But first, let's turn to the actual research that's driving some of these recommendations. This is a report that we published a little over a year ago. It's a 50-state review of public pension fund investment practices, their performance, and their reporting practices. I pulled this up because it's the most recent investment review that we've done. However, we are about to release within the next few weeks an update to this with 2016 data. And so the remainder of my presentation will provide some highlights from the updated data. Next slide. The scope of the study, both with the 2014 data in the old report and the 2016 data that we're releasing shortly, is comprehensive public data for the 73 largest pension funds sponsored by states in the United States, and that represents about 95% of the assets held by state-sponsored public pension funds. Next slide. Those data come from comprehensive annual financial reports, pension plan actuarial valuations, and other reporting from the plans. We also use data from the Fed and Wilshire Tuck's to benchmark some of the data coming from the states themselves. Next slide. Just a few thoughts on the findings from our previous report, and these are supported by our new data as well. Only 2 of the funds examined using 2014 data actually exceeded their investment target returns over 10 years, and that's something that we'll drill down on a little bit today. The new data for 2016, none of the plans met or exceeded their target rates of return over the last 10 years. So that's an important finding. The use of alternative investments has increased substantially over the last 2 decades. It's important to note that performance varies widely with these investment vehicles. Those funds with rapid and recent entries into the alternatives market have reported the weakest 10-year returns, and those who have a long-standing alternatives program are among the top performers. Perhaps most importantly, next slide, is this shift in investment practices over the last several decades really indicates a need for uniform full disclosure. And some of the items in particular that we're focused on, and I'll talk about this a little bit more at the end of my presentation, are the need for net of fee reporting on performance, full disclosure of alternative fees, particularly for private equity, and a more robust risk reporting. And this includes the stress testing that I'd mentioned previously. Next slide. So let's dive into the data. Next slide. Anna mentioned this at the beginning of the webinar, and this chart just illustrates the significant increase in risky assets being held by state pension funds over the last 50 years or so. Less than 5% of assets were held in equity or any risky asset in 1956, but by 2016 that had increased to 75%. So the vast majority of portfolios are now held in stocks, with 25% of portfolios in alternative assets. And just to be clear at the outset, and I'm sorry I didn't do this earlier, alternatives include real assets like real estate, private equity, and hedge funds. So a quarter of the assets in the system-wide are in alternatives, half the assets are in public equities. And if we want to drill down a little bit on this use of alternatives, particularly over the last decade, their use has more than doubled, from 11% in 2006 to 26% in 2016. And this is an important point to realize. Alternatives are hard to value. They're often more volatile than even public equities, and therefore can expose a fund to increasing risk. And equally important, they're often more costly than traditional investment vehicles. Management fees plus performance fees can total up to 3% of the asset value, and that's a very significant cost, particularly when you compare it to expected returns of, say, 7 or 8%. Next slide. So with 75% of assets in equities and alternative, as I suggested, there's significant volatility in returns for funds. And this chart really illustrates that. The blue line is the Tuck's federal and state defined benefit plan median performance over 10 years, 10-year performance over a period from 2005 to 2016. And the gold line is the S&P 500 return. And you can see just how closely they track to one another. They're virtually identical. The blue bars reflect the impact of that volatility on assets across the system. And so you can see a dip in assets that follows, for example, the downturn after 2008, and just how long it took for asset levels to rebound after that downturn. Next slide. So is that risk exposure actually allowing funds to hit their target? And I alluded to this at the beginning of my presentation. It is becoming increasingly difficult for funds to do that. And this just illustrates the point that I made at the outset. Not a single plan in our 73, or excuse me, fund in our 73 funds examined met their 10-year target in 2016. South Dakota came closest. They were within a 0.5 percentage point of their target. Indiana, conversely, was over 3 percentage points below their target, which is quite significant. And again, those are 10-year returns. Next slide. The good news is that policymakers and plan administrators are beginning to adjust their expectations, recognizing that we are in a lower rate environment. The map on the left shows expected returns in 2014 as reported by states, Only 9 funds in 2014 had targets below 7.5%. But in the intervening years, 21 states have lowered their assumed rates, and now over half of states are under the 7.5% target today. So there is a very positive trend in recent years. So what is a reasonable rate of return? That kind of begs the question, how are we doing collectively in this exercise? Our recent research, and that done by market experts in the private sector and in academia, suggests that for a portfolio with allocations like that of the typical public pension fund, a median long-term return of 6.4% is a reasonable expectation. The corresponding 25th percentile return would be 4.8%, and the corresponding 75th percentile return would be just over 8%. What's interesting on this graph is that the bars represent the number of funds in our study that correspond to those expected returns. And we find that virtually everyone expects to be at the 50th percentile or above over the next 10 years. And most of them are quite a bit in excess of that median return. And this suggests that further decreases may be warranted in the coming years. Next slide. Finally, I wanted to swing back to the topic of fees, which I touched on very briefly at the beginning of my presentation. Increases in fees are highly correlated with a movement into the expensive alternative investment vehicles. We've seen an increase in the reported fees of over 30% since 2006. And in many cases, these reported fees do not include the performance fees that come along with private equity and hedge funds in particular, and some real estate investments. So these are, if anything, conservative estimates. I do want to note that there's a wide variation in reported fees across the 73 funds in our study. The average was 0.33%. As the graph indicates. But the highest fees reported were reported by the Arizona Public Safety Plan, almost 2.25% of their total asset value in a single year, versus Georgia Teachers, which is at the bottom of the distribution with less than 0.1%. Next slide. It would also be remiss of me not to mention, and this is kind of turning to the transparency and reporting theme that I raised at the beginning. A full third of the funds in our study report their performance before deducting fees, and this is significant. If you're reporting a 7% return over a 10-year period, but you're paying 1 or 2% in fees each year, that really reduces the reported performance that your stakeholders are reading about. So this just gives you a sense of the distribution of gross versus net reporters, and gives us an indication of where improvements will lie, hopefully in the future on that. Next slide. And this brings me to my last slide. I would be remiss not to talk about our recommendations for transparency. Given this move to more complex investment vehicles and the corresponding fees. I won't go through all 6 of them, but I wanted to highlight 3. As we just discussed, we recommend disclosing bottom line performance. That means reporting performance both net and gross of fees to give stakeholders a clear sense of the cost associated with the investments in a fund's portfolio. The 5th one also bears some stress, adopting comprehensive fee reporting standards. This speaks to this idea that I mentioned earlier that high-cost investment vehicles like private equity come with much higher fees, and often those fees are not reported separately. The Institutional Limited Partners Association has very detailed recommendations on comprehensive fee reporting, and we recommend compliance with those. And finally, the last item, adopting mandatory stress test reporting. I haven't talked a lot about stress test reporting here, but we find that it's a very powerful way to illustrate the long-term impact of economic downturns and contribution shortfalls on the economic and financial position of a plan. And I just want to highlight 3 benefits of stress testing. The first is that they help plans prepare for the next economic downturn, and that's really what we're talking about today. The second is it promotes good funding practices, which can also save money in the future. And finally, it is a powerful tool to score reform proposals based on a range of possible economic and contribution scenarios. I should also note that stress testing is currently being adopted at a fairly quick rate. There's a trend among the states to adopt mandatory reporting of stress testing. Currently, there are 7 states that require mandatory stress testing reporting, and 5 of those states have adopted it within the last year. So we're very encouraged by that trend. And with that, I will close. I thank you for your attention. I'm happy to answer any questions, and I'll turn it over to Todd.
Thanks, Susan. So as mentioned by Anna before, my name is Todd Hauser. I'm a director at S&P Global Ratings, and specifically for municipal pensions. So I was brought on to evaluate public pensions, their health, their sustainability, the trajectory of their costs, and then to tie that all into the credit story. Previously, I was a senior pension actuary for CalPERS, and a lot of my focus towards the end was on asset liability management. And so there we developed risk modeling, and it was with a very strong focus on looking at key contribution drivers, including asset volatility and how that affected the system. So I'll talk about that a little bit more later on in the presentation. But to start with, next slide, please. To start with, this is just a survey that we do at S&P of the 50 states and their primary pension plans. And looking at this graph, the first thing that strikes me is the diversity of the states, right? There are many that are pretty well funded, above 80% funded, but even down to below 40% funded and everywhere in between. There's a great variety amongst the 50 states currently on how pension plans are funded. And we did a deeper dive. We looked at the top 5 states in terms of funded status. At the time, they were New York, South Dakota, North Carolina, Wisconsin, and Tennessee. And we looked at what kinds of things did these states do to enable them to manage their pension systems so well. And Susan even mentioned earlier Wisconsin and Tennessee because of the risk sharing characteristics that they had. And there was a lot of good information that we discovered, but for the purposes of this webinar, I'll just mention that all 5 of these states had low discount rates. So specifically, that speaks to the asset allocation and what those states had. And then also generally, it speaks to having conservative assumptions and measuring liabilities in a conservative way so that they can be dealt with. So if we move on to the next slide, this also helps set the stage for our perspective. This slide is basically fixed costs that states handle. And by fixed costs, I don't mean that they don't change at all year to year, but that they don't change very much, and they're long-term obligations. So here you have Medicaid combined with debt service and pension and OPEB contributions as a percentage of general fund expenditures for each state. And again, there's a lot of variety across the slide, across all 50 states, but on average, you can see that these combined fixed costs are almost 30% of general fund expenditures, which is quite a high amount and higher than it's been in the past. And some states are approaching 50% of general fund expenditures. And another important thing to note here is that this is probably understated for various reasons. Some pension plans aren't being funded as much as they should be, so that reflects on a lower contribution. And OPEB plans in particular, many of them are pay-as-you-go. And when a plan is funded on a pay-as-you-go method, then typically the cost trajectory increases dramatically over time. So those costs are just going up over time. And that's what we pay attention to at S&P. It's not just what are costs now, that's very important to us, but also what kinds of funding methodologies and funding discipline are going into, especially the pension and the OPEB plans, and what kind of trajectory will that cause to to these plans in the future, and what kind of contributions and growth will we see there. So that sets the stage. Let's move on to the next slide. I think this is a very interesting slide. This is getting now into actual discount rate and portfolio allocation. So this slide is trying to ask and answer two questions in regards to the discount rate. First of all, how accurate has the discount rate been in the near term? And Susan talked about that quite a bit with the 10-year return. Here we're looking at the last 5 years. And the second question is, how risky does that discount rate imply? How much risk is there being taken on? So there's 3 dimensions. The first is just a color for the 50 states with their primary plans. The bottom border is about a 6.75% discount rate. It goes up to about 8% with the light blue. So the darker the blue, the more conservative the discount rate. And then the y-axis is answering that question, how accurate, at least in the short term. So this graph looks from 2010 to 2015, what is the average investment return? And then compare that average to the discount rate over that time period. And in this case, excuse me, 49 out of the 50 states are actually above zero, above that x-axis. And that means that they've actually earned more over those 5 years than their discount rate. But you have to keep in mind it's very dependent on the window. This is 2010 to 2015, which was after the bottom of the Great Recession and was during the stronger part of the recovery. But we can look at this over different windows and different time periods to evaluate how well they're doing compared to their discount rate. And then the third dimension to this is how risky are the plan assets. And that's really shown here on the x-axis. So we look at how much equity and alternative investments the plan had in 2010 and then compare that to how much they have in 2015. And for most plans, we've seen a sharp shift over to the right, meaning that they've taken on more equity and alternative investments. In fact, over these 5 years, we've seen on average across the 50 states that equity and alternative investments have grown by 8% from 5 years back. So that's quite a big shift into more risky investments, and also parallels what Pew's research on their side. So if we go to the next slide, I'm going to shift gears and dig a bit deeper into this experience at CalPERS and what CalPERS has done to kind of evaluate these risks and manage them over time. I do want to just give a reminder here that while I did work for CalPERS for a little under 10 years, I'm no longer employed by them and I'm not speaking for them. So the information here is publicly based, but I can speak to the modeling that was developed while I was there and which they still use to today. And I think it's a very valuable discussion. So this first slide is, you should all be familiar with this discussion at this time, the clear demographic trend of more retirees compared to actives. This active to retiree ratio trending down. On this slide, you can see it for both CalPERS specifically, and then just from a general NASRA public funds survey. And a part of this is just a natural progression. When a plan starts out, they have all active members, and there's only contributions going in. There's no benefit payments going out. And then as that plan matures and gets older, more of the active population retires, and that retiree population grows. So that's natural. But on top of that, we have this compounding effect due to the fact that right now we have baby boomers retiring in droves, just about 10,000 baby boomers a day retiring, which is more retirements than we've seen in the past. And also our retirees are living longer. In terms of longevity, it has improved, and so we've seen a greater number of retirees and those retirees living longer. And what that means for pension plans is that they have to have a much larger asset base than in the past to support these retirees. And so when assets are volatile, when they go up and down, it's a bigger shift compared to the past because the asset base is so large, and it's going to affect contribution rates, volatility, and then the budget much more than we've seen before. So the bottom line here is that plans are more sensitive to investment returns. And this is before getting the discussion of how those investment returns have changed based on asset allocation and the volatility of those returns. So this is the next slide. And this is very similar actually to one of the slides that Pew presented, but it's specifically looking at CalPERS. On the left axis, we have two lines coming forward. It's the assumed rate of return all the way back to over 50 years ago and the 10-year treasury. And you can see that for the first 20 years or so, the 10-year treasury and the discount rate, the assumed rate of return, were pretty well in concert. But then in the next 30 years, the treasury's trend was straight down, and there was no recovery, no looking like it will go back to previous levels, and interest rates came down with it. So there's this major shift in the long-term economic environment, and yet the discount rate, the assumed long-term rate of return, has not come down in a similar fashion. So the only way that that's possible is looking at the right axis, which governs this heat map, which is the portfolio allocation amongst asset classes for CalPERS. And at the beginning, 50, 60 years ago, there was 100% of their portfolio was in fixed income. And they started to add some equity into that. And then as the treasury rate went down, you can see this large surge in equity, and of course the volatility associated with equity. And then on top of that, you can see the introduction of these other classes, private equity and real assets, which are often real estate. And both of those are complex, as was discussed earlier, and also add a lot of risk to the portfolio as a whole. So fixed income went from 100% of the portfolio down to present day, maybe about 20% for CalPERS and for a lot of the plans that we see out there. So now we have this whole picture where there's demographic headwinds that cause plans to be more sensitive to investment volatility. And then we have portfolios that are taking on much more volatility that we've seen in the past. And those two together provide quite a challenging environment for pension plans today. So with that, let's move to the next slide. This is very interesting. It'll take a little bit of explanation, but basically CalPERS as a state did enact a strong pension reform in 2013. It was called PEPRA, the Public Employees Pension Reform Act. And that reform reduced benefits on multiple dimensions. So it did quite a bit of work towards reducing benefits provided in the pension system. But because of California precedent in the legal system, that could only be applied to new hires going forward. So as new employees started turning over and replacing old employees, they were given the lower benefits. And you see over the next 30, 40, 50 years, this lowering of benefits, and because of that, a lowering of the sensitivity towards investment returns. You don't have to have as much assets when benefits are lower. And Pew also mentioned that earlier. So what this slide is doing is saying, let's say the fund experiences a 10% investment loss. At the time, CalPERS assumed a 7.5% return. Let's say they got instead a negative 2.5 return. So if that happened in 2015, the contribution rate for a sample miscellaneous plan they looked at and a sample safety plan they looked at would go up by 4 to 5%. But if instead that happened not in 2015, but 2020 or 2025, the contribution rates would go up by even more. There was more sensitivity to that same loss. And that's what we're talking about when we're looking at the demographic headwinds that we've seen. But you see this tension between the demographic headwinds and the pension reform that CalPERS implemented, so that over time, finally, that peaks the sensitivity to investment return. And in the end, as the entire population turns over into these lower benefits, it's actually back reduced down a bit. So as Pew mentioned earlier, there is some hope going forward as we see a lot of states implement pretty strong benefit reforms, but it may be a long ways down the line. And in the meantime, there's a lot of danger associated with the sensitivity of investment returns that we can see here. So let's go on to the next slide. So this is just a slide discussing what CalPERS provides, and I think it's very important, an important discussion to be had for public plans across the nation to evaluate and measure the risks. And one of the primary risks are these investment risks that we're talking about for pension plans, so that there can be a well understood discussion about what plans are facing and what can be done about it. So for CalPERS, in their annual evaluations to every employer, they provide a few measures of risk on investment return. One is a 5-year projection of contributions based on if investment experience is maybe very bad, the 5th percentile, weak at the 25th percentile, what they expect at the 50th, and so on. So employers can look at these projections and understand what's going on based on the current market environment and prepare ahead of time. Additionally, CalPERS provides discount rate sensitivity at 6, 7, and 8%. Right now, they're heading from 7.5 down to 7 over 3 years. But this can show what kind of liability plans would have if over the long term, the expected long-term rate of return changed. And then finally here, volatility ratios. Volatility ratios are actually very simple but good metric of showing what a plan's sensitivity to investment return would be. So an example of volatility ratio is asset to payroll ratio. In that case, if the plan has assets of $1 million and a payroll of $100,000, that ratio would be 10, right? The assets are 10 times as much as payroll. And if there was a loss of 10%, like I mentioned on a previous slide, 10% of 1 million, so with that asset to payroll ratio, that loss would be the entire year's salary that paid to employees, the entire year's payroll. So it shows how much at risk you have in terms of assets based on the amount of active employees you have. Another good ratio is liability to payroll ratio, which is very similar, but liability is saying if your assets equal your liabilities, right? If you're 100% funded, then this is what your sensitivity would be at that time. So both of those are very useful and give further insight to what's at risk in terms of current assets on hand for a plan. And then one other thing that CalPERS does, or at least they have done in the past annually, is they've produced a funding levels and risk report, which does stochastic modeling. It uses, I think it's 5,000 scenarios to look at possible things that could happen to the plan, and based on certain metrics. It could be based on what portfolio is chosen, what kind of volatility of the assets they have, and they measure it against these 3 metrics: the probability of falling to a low funded status, probability of employer contributions reaching high levels, and then volatility, probability of high contribution increase in any given year. And so the goal there, of course, is to minimize these 3 risk metrics, but they're at tension to one another, so it's always a balancing act. And so I won't go into any more detail on those, but the main point here is to bring it back full circle is stress testing is very important. And as mentioned with the Pew stress testing article, our view is that sound governance of these pension plans includes modeling and understanding key risks like the asset volatility, and that can primarily be done through stress testing or with a variety of other models baked in as well. And that not only helps the system understand what risks they're facing, it also provides greater transparency to all stakeholders and reflects positively on the trajectory of the pension system over time going forward from there. So I think that's the really important point that I want to leave with for my part of the presentation. And with that, I'm happy to turn it over.
Okay, thank you. It's Representative Mike Tobash. I'm calling in from Pennsylvania, and I appreciate everyone listening to what Pennsylvania has gone through. And I think that I'm going to reiterate much of what we heard already from Todd. It's been a tremendous education, I think, working in these systems. I'm a registered investment advisor. I'm in the insurance business. We do insurance, and then we do individual retirement planning as long as group retirement plans. And I've been gratified to do this work in the state of Pennsylvania, and I think we're moving, certainly, and we have moved. We got some very important pension legislation implemented just last year, and it's going to affect new employees starting in the year 2019, the beginning of next year. So let me just give you a little bit of background. We have 2 systems in the state of Pennsylvania. There's the State Employees Retirement System and the Pennsylvania State Educators Retirement System. And as I'm sure many of you are aware, not every state has 2 systems like this. The PESER system, the educators system, has about $56 billion in assets. It's the 15th largest pension system in the United States. CERS is about half of that size. So we've got quite a few individuals, citizens in the state of Pennsylvania that rely on these systems. So I was elected first in 2010, started the work in 2011, and in that year, our funding levels were about 60%. Again, I'm going to go back to just a little bit more background. I'll give you a lay of the land. Prior to me getting into office, Act 9 of 2001 occurred in a period of time when the systems were overfunded, I think about 114%. With that legislation, Pennsylvania lawmakers saw fit to increase benefits for people in those two pension systems retroactively, about a 25% increase in benefit. Right after 2001, the market starts to go south, and we start to get into a chronic underfunding state. So in 2010, again, the year that I was campaigning and first got elected, the legislature enacted Act 120. Again, the funding ratio at that time was about 60%. What it basically did was reset for future employees their retirement benefits back to the pre-Act 9. So there was a 2-point multiplier prior to Act 9. It was increased to 2.5 in 2001, kind of reset most state employees and school district employees back to the 2-point multiplier in the defined benefit system. But the reset only took place, as Todd mentioned, for future employees. So the state was not aggressive enough, or the courts would not allow existing members, even though in 2001 benefits were increased, to reset those existing members of these systems back to where they were before. So for future employees, it did develop a tremendous amount of actuarial savings, and the problem got worse because those actuarial savings were used to apply collars or to limit contributions in the plan for the next 7 or 8 years. And we're in 2018, so we are just on the other side of the collars. So the Act 2000 and Act 120 in 2010 reset the benefits back, and then said that we're going to utilize those actuarial savings and get on track to pay the required contributions in the future, not immediately. So during that period of time, the funding status continued to go in the wrong direction. But in 2018, we find ourselves paying pretty much the full actuarial required contribution rate, which is a tremendous burden on our state budget. We saw a slide earlier, and I thought that the average was 7.3% of budgets. We are about at 10% of our total budget are going to the retirement costs for employees in the Commonwealth, which puts our state and our school districts in tremendous budgetary distress. Here's the number, and it is north of 35% of payroll right now for the people in the state system and for people in our school districts. So in this last year, we passed Act 5 of 2017. Again, there was a plan design change addressing some of the concerns that we've talked about here, and that being the tremendous amount of risk that exists within these defined benefit pension plans. So the plan that we have implemented, again, will begin for future employees starting in 2019, and it is a hybrid plan that's got 50% defined benefit and 50% defined contribution, a 401k type system, with the opportunity for future employees to enter into a solely defined contribution plan if they so desire. So during that effort to change the plan design, we tried to develop savings, and it was a requirement of some people. Because of the funding levels, we were taking a look at developing savings within the plans. So there's a couple of things that we looked at. Number one, we could reduce the benefits. Not a very popular thing to do, reducing benefits, and difficult for Pennsylvania legislatures to get that across the finish line, as I think would be the case with many of you. Number two, we've had this conversation about the discount rate, about reaching that discount rate, and about making sure that you're paying the full amount into these plans so that they are solvent and that they are fully funded. So consideration to accelerate the contribution rates and try and exceed the discount rate that we have now set at 7.25%. And then the last thing that we took a look at was lowering the fees. So if you go to the next slide, I'll talk about this just briefly. So you see the two systems here, and in the original plan that we had developed, we were realizing savings of between $12 and $16 billion, let's say $14 billion, depending on the actuarial payback that we were utilizing. So during that period of time when we're looking at this, there was no meaningful reduction or budgetary savings, because again, we were only talking about future employees. So there's no relief to the budget that would immediately take place. And many reps and senators and citizens saw that as not being pension reform. Even there was a tremendous amount of shift in risk over to the defined contribution hybrid model, without immediate savings, many people found it difficult to justify their vote. So we faced this situation. The reality of trying to implement pension reform in the state of Pennsylvania was difficult. So you go back and you take a look at what we did and why we should do it. I think the underfunding is really what caused us to play the hand at getting more disciplined and having a different plan design. But without the ability to reduce the normal cost, we found ourselves in a situation that we still struggled to try and develop savings to help our underfunding status. So one of the things that occurs to me, being in the insurance business and working in this realm for a number of years, is the increased scrutiny to fiduciary liability. So if you'll notice, and you Google the amount of lawsuits that are taking place by participants, class action lawsuits against 401k plan sponsors, you'll see that it is increasing at an alarming rate. The thing that occurs to me is that at some point in time in the future, we very well may see a class action lawsuit against a defined benefit pension plan with the taxpayers or the participants as the plaintiff, and the day that there's a lawsuit in favor of those participants and the taxpayers, we have really got ourselves in a lot of hot water. So I think the fiduciary liability that is required of the people that are managing these systems is really different than it was a decade, 5, even 3 years ago. I think it's important that a lot of focus is given to that. So without tremendous savings and budgetary relief, there was one element of the law that we passed, and that was to establish the Public Pension Management and Asset Investment Review Commission. If you could please go to the next slide. So the commission was established within the law, and it was a 5-member board. There was someone who was appointed by the governor and someone by the Senate Republican caucus and the Senate Democrat caucus, as well as the House Democrat and Republican caucuses. So I was fortunate enough to be appointed by my caucus onto this board, and I now act as the chair of that board. So we're interested in seeing what's going to occur in the state of Pennsylvania, but it gives us an opportunity to have greater focus on the fees that we are paying and the returns that we are receiving. So basically, the commission was formed with the requirements that they study the costs and benefits of both active and passive investment strategies, that we take a look at the performance, that we study alternative and future investment strategies, that we make recommendations on improving investment fee transparency. We've talked about alternative investments and the cost associated with those in many cases. We need to implement recommendations, particularly focusing on the Society of Actuaries and their Blue Ribbon Panel on stress testing. We need to publish the findings, and we're going to be happy to make those public record, and hopefully the work that we're doing in Pennsylvania may help other states and other systems not have to reinvent the wheel. The commission was especially formed and specifically tasked with developing recommendations to reduce expenditures to generate actuarial savings of $1.5 billion in each of the systems over 30 years. So specifically, they said you've got to come up with strategies to reduce costs to save the state $3 billion over the experience periods. So we're set up and we have started to run. If you could please go to the next slide. So on the next slide, what we've done is set up a series of hearings with 3 basic themes. And the first theme, and we're going to have this first hearing in July, best practices on transparency and fee reporting and stress testing. The second hearing will focus on an analysis of the Pennsylvania pension funds on the following: asset allocation, we're talking about assumed rates of return, investment manager selection, investment performance within each class versus the benchmarks, and we're going to take a look at cost savings initiatives for the third hearing for both pension boards, outlining the cost, benefits, and limitations of each opinion that we hear. I've really been gratified by the number of people that are coming to assist Pennsylvania in getting our pencil as sharp as it can be and focusing on, you know, a good mix of asset allocations. We have interviewed quite a number of testifiers, and I think we're going to be hearing, I know we're going to be hearing from people, and we're going to be discussing a couple of these topics: active versus passive management, external cost versus internal costs. We're going to try and make sure that our break points and the savings that we're getting a very good deal on the investments that we're making. As I mentioned before, we've got 2 systems, and it is expensive to run 2 systems. And we are certain that in Pennsylvania, we're not always getting the best and lowest cost investment advice that we can. And then we're going to take a look at our asset allocation and make sure that we're disciplined in that regard with sticking to our asset allocation. I'm just going to give you a little bit of an idea on who has offered to testify at these number of hearings. As I mentioned, we've got people from throughout the world that we have interviewed. Our treasurer, Joe Trisella, has been instrumental in helping us get a good lineup of people who will testify. And we've got a number here. We've got Dr. Leduvic Filippo, who is from the University of Oxford. We've got Bob Stein, who's the chair of the Blue Ribbon Panel on Public Pensions from the Society of Actuaries. We've got Dr. Chester Spatt. He's from Carnegie Mellon University and MIT. We have got Craig Lazara from Standard & Poor's. And as our consultant, we have hired a gentleman from California by the name of Ashby Monk. He's working with Stanford University. He's a graduate of Princeton. He's got his doctorate from Oxford University. He spent some time at the University of Paris. He has worked in both the Australian and the Canadian systems. We've had an opportunity to have conversations with all of these people, and we're anxious to hear the testimony and put together a document that will help Pennsylvania moving forward to make sure that our fees are commensurate with the risk that we are taking. You know, this kind of really started back in 2013 when I was working closely with our governor at that time and the budget secretary, Charles Zogby. We did a study with information that was available in the marketplace, and it is very difficult. It can be very difficult to understand exactly what your fee structure is, because many of these contracts are not publicly disclosed. So when you're talking about alternative investments, understanding exactly what the fees are and reporting them in a public fashion can be difficult. One of the things that the commission is tasked with is transparency, so we're going to certainly try and get better. But many of the people that we've had these discussions with quickly point to the fact that we think we know what your fees are, but we're not certain before looking at the contracts. But you know, this idea of transparency, I think, is really important. It's my belief, and I'll give you an example, that the mere formation of this commission will save Pennsylvania taxpayers in these systems hundreds of millions or the billions of dollars that we are tasked with savings. saving. So let me just give you an example here. So on March 27th, the CERS system had their public meeting, and their chief investment officer, Brian Lewis, he made this quote: "In addition to managing the risk of the portfolio, we have also been working hard to negotiate lower fee structures and pursuing co-investments and similar opportunities to achieve better fee arrangements." I mentioned 2013. The public information that we looked at had the PCERS and the CERS systems as the third and fourth most expensive managed systems in the United States. And the opportunity for hundreds of millions of dollars of savings in that year by just getting down to the average gives us hope that we'll be able to, as I mentioned before, easily outperform what we're tasked with, and that is saving over $3 billion in fees within these systems. I think, as I mentioned, the fact that the commission was formed has both of these systems taking a hard look at what their fee structure is. There's so much evidence right now that the idea of having actively managed pension systems and funds is really not a goal state. As I mentioned, in 2013, when we looked at the cost, there's something else that was really glaring, and that's that Pennsylvania's two systems both performed in the bottom quartile of their peers. So high fees, low performance has us taking a hard look at what we have done in the state of Pennsylvania and certainly trying to get better. All of the data that is out there points to the fact that we're in a changing climate and environment. The fact that when we talk about the risk that many of these systems have taken in trying to get to these high discount rates, and I really understand what's going on. And I think it's important to note that, again, the political will for many people in the legislature to reduce the discount rate, which immediately causes the ARC, the required contributions, to go up, can be very difficult in tough budget cycles. So, you know, the exercise in implementing new plan design and shifting risk away from the Commonwealth in the future, I think, was a great endeavor. However, I think we need to do more work, and it's become apparent to me that one of the ways to reduce costs is to just become more transparent. And in a climate of fiduciary liability and transparency, I think that we will see these pension costs with a downward trend. So happy to be doing this work, happy to be on the webinar today, and happy to answer any questions that anyone might have about the process that we undertook and what we're trying to accomplish here in Pennsylvania. So thank you very much.
Thank you very much, Representative Tobash. At this time, we're happy to take maybe one question from the audience. If folks want to type their questions into the Q&A box on the right-hand corner of their screen. If we're not able to get to all of the questions that come in, we will follow up with you individually after the event. Okay, it looks like we have one here. Have you heard any discussion of proposing changes to federal tax law that would allow states to use pension bond revenue to be reinvested in private bond markets to generate arbitrage again? Let's go to Susan and Todd for this.
I am not aware of that, but I don't know if perhaps Todd is a better source of information on that particular topic.
Well, I agree. I am not aware of that being reintroduced.
Okay. Thanks very much. This brings us to the conclusion of the webinar. If you have any questions following this event, please feel free to contact us at the email addresses shown. If we could go to the next slide, please. And the next one. Great. This webinar is being recorded and will be archived on the NCSL website. And last slide. Finally, if you all would please take a moment to share your feedback on this webinar by taking a short survey after it concludes. Thank you very much for your interest and participation today.